Good morning, everyone. My name is Damaris, and I'm in Marketing and Communications. Welcome to the Genghis Weekly Investor Briefing. It's week 40 of a termless week, and it's so wonderful to see so many returning attendees. Thank you for making the time in your schedule to attend our weekly Monday sessions. We hope that you continue to find them insightful and educative. To the new attendees, we say thank you as well for taking the gamble and registering for our sessions and joining us. We will deliver on the promise of providing you with the perfect start to your trading week. Now, shortly, I'll hand over the briefing to two incredible, knowledgeable gentlemen. Gerald, who will guide us through equities market, covering the week's performance expectations, as well as sharing trading recommendations that can be buy, sell, or hold advice. Churchill will then educate us on all things microeconomics and fixed income. He'll also let us know what we should be eyeing in this space. Ours is a very interactive session, and that's probably my favorite part of the entire briefing. So the presentations are brief, and in that time, please feel free to use the Q&A tab that you can see on your screens to send in your questions, or use the chat function to share your thoughts or comments related to the financial markets. We will attend to them after Churchill's segment. So shall we begin? Gerald, please start us off.
Thank you, Damaris, and good morning all. Let me share my screen. So we'll begin with recap of what happened last week. I think last week we could say we had some steady market, very marginal movements compared to the prior week. The Nairobi All Share Index was up about 0.1%, basically stable, and the C20 was unchanged. So as we come to the close of the quarter, I think activity is going to be a bit muted. But key to watch this week is the presidential address. I think there's some hope that there's going to be some sort of economic reopening. And if this pans out, then we expect some activity to pick up in the equities market. So turnover was down about 33.1%. Remember that in the prior week, there was a very large trade on Safaricom, about 1.1 billion on Thursday. So since this was not there last week, that's why you see turnover drop by such a percentage. So foreign participation continues being above average, 79%. Last week was about 77%. And during the week, they turned to net sellers in the market, especially on Safaricom, EABL, and the equity group. So we could say that the market was, from the foreign end, the market was fairly profit-taking during the week. And given that prices have somewhat, on a short-term basis, somewhat hit a floor, then we expect that these levels will continue being sustained unless there's some good news from the presidential address. So so buys of the week from foreign end was KCB, nothing unusual, selling equity, EABL, and Safaricom. So equity and EABL, as you could note, they have been selling from these counters for the last about 3 weeks. So a lot of profit taking from the foreign end. So top traded counters, the usual Safaricom, KCB, equity, and EABL, basically the largest market cap stocks you could get in the NSE. Compared to where we trade versus our African peers, so 9.2 times market pre-E compared to 12.9 on average. So very, very good levels. Dividend yield, again, very attractive compared to where the African peers are, 5.2 compared to 4.5%. So these are attractive levels, both to local investors and also to the foreign investors. Ideas for the week. This week we are long term. Looking at KCB Equity Group, if you have seen their historical performance, the two banks usually have the best performance in the banking sector in terms of superior ROEs. And even during the pandemic period that we have been through this year, their performances have been quite strong, despite definitely the drop in performance. The ROEs are still above sector average, and we expect this to be sustained during this period and also in the long term. So again, for the two banks, price multiples, basically the price to book ratios, very attractive. I think KCB is about 1.0%. It has traded below that compared to historical average above 1.4, 1.5. Equity group at about 1.4. Equity group has had price to book ratio of over 2 times. So the current price multiples are quite attractive compared to their historical averages. So definitely this reflects the performance of the two banks in the short term, but in the long term, as this pandemic phase, we get through the pandemic phase, then definitely performance is expected to pick up. So we have maintained again what we had last week in terms of our argument against a dividend strategy on Centum, specifically because of an attractive dividend yield, about 5.7%. So again, I will reiterate what I said last week. The business is going in a growth phase, heavily focusing on real estate, and definitely this is a business that will require much more capital. For that growth that they are pursuing, and definitely means that the dividend is expected to be quite low for some time. So we don't recommend Centum as a dividend stock. We believe there are other stocks that have much more attractive dividend yield at current market prices. So our corporate calendar still remains almost the same. Centum books closure this week, Kenyari that is next week, and Kengen on 22nd of October. Then the key thing again is a presidential address. I think this is something that investors are very keenly looking at. If there's going to be a reopening of the economy, I think given the current numbers that you have seen in terms of positivity rate, and it means business activity could resume, and this definitely means that the prospects for the business sector is expected to pick up as we go to the fourth quarter of the year. So the key, it is key to watch that speech and see what the president communicates to the country, which is going to definitely have an impact on the stock market. So Churchill could take us to FI and macro. Thank you.
Thank you, Gerald, for walking us through the equity segment. Let me share my screen shortly. I'll start with the calendar for this week. As what Gerald has finished off, he's saying that right now, actually either today or tomorrow, we'll be waiting for the presidential address after the conference that is slated to be held today. So we can see whether there could be an extension of the current containment measures, or there could be a complete cessation of the containment measures as we know them. Having said that, even this week is quite heavy on the economic front. Tomorrow we have the Monetary Policy Committee meeting with the CBK, and largely we've put out a note actually in under an hour on our expectations. We expect that the CBK MPC will retain the benchmark rate at 7%. From our demand side of credit, we don't see much demand just looking at the economic expectation in terms of growth. So we don't see much appetite for credit in the current environment. And also from a supply side, in particularly what came out in mid this month, the budget review outlook paper, which was preempting that even the net domestic borrowing will increase by 60 billion. So even from the supply side, banks will be more skewed towards funding government securities rather than the real sector. So net all in expectations, you expect that even the CPR rates, but that those are covered in the report that you put out on today. Also on Wednesday, we have the inflation rate for the month of September. August, the inflation rate was at 4.36%, which was same as 4.36% that was recorded in August. But having said that, core inflation went up slightly from 1.6% up to 1.9%. And fuel inflation, remember all these global oil prices has been on an uptrend, just coming from the lows that was witnessed, particularly mid-April. So that has had a knock-on impact even in the current Energy Petroleum Regulatory Authority monthly price, fuel pump prices. So we've seen that even fuel inflation in the month of August was up to 10.7%. But having said that, just looking at the global oil prices in the current month, we've seen that right now it has averaged around $41.9 per barrel. So, and that has been a decline of 7% for the month of September. So what we are seeing that in the next fuel pump price review, this will have some decline in the fuel prices. So we expect that even going forward, fuel inflation will not be as elevated as we saw in the month of August. Getting on to what I call the main report this week is now the second quarter GDP report, though this one is more of a rear view mirror because we are looking at a period which passed like a quarter ago. But just looking at some of the indicators that were released in the second quarter period, this is basically April to June period. And this was when COVID-19 was at its highest in terms of even the containment measures that were put by the government and also the knock-on impact from abroad to the Kenyan economy. So start with unemployment rate in that quarter was that we saw a doubling from 5.2% in the first quarter to 10.4%. Looking at even the tax receipts for the second quarter, what KRA collected from taxes and comparing with the similar period a year ago, we saw that there was a dip of around 20.6% to around 333.5 billion that was collected in tax receipts. And looking at the average PMI is Purchasing Managers Index, which is basically a pulse of the private sector business sentiment in the economy. So the average was 39.7, and anything below 50 is just showing that there's a contraction in the country. So amongst other indicators, core inflation was subdued. Core inflation is a proxy to what is called the demand pressure in the economy. That was quite subdued, below 2%. So if you look at all this data that already has been put out, we are seeing that even the second quarter GDP print will be quite subdued. We're looking at even negative growth. But having said that, what we are also expecting is there could be a likelihood of the report that will be out this Wednesday will have a rebasing, whereby rather than having the base year at year 2009, it could now be brought forward to 2019. And why am I expecting it to be in this month? If I may take you back to 2014 September, that's when the last rebasing report came out, and it was based on 2009 as the base year. And what was the import of that? We saw that 2013 GDP numbers were revised upwards to the tune of 25%. And that's the one thing that now took Kenya into a middle income country status. So that's one thing. It came around September, and it had an effect of increasing the GDP numbers by 25%. Another thing, earlier this year, the CPI, the Consumer Price Index, was rebased to base year 2019 with the month of February. So and if I add all these two factors together, I'm saying that there's a higher likelihood that the report that will be coming out on Wednesday will have a rebased GDP numbers with the base year of 2019. But this is all conjecture. We just wait to see whether the actual 2020 GDP, second quarter 2020 GDP report will indicate our expectations. But that's something that you, as investors, need to keep an eye on. And finally, the balance of payment report, which will also come in tandem with the GDP report, the same date, 30th of September. Just quickly, a review of last week's fixed income. In terms of secondary market activity, we saw a decline 21.2% week over week to 12.2 billion that was traded over the course of last week. And in particularly, the papers that were traded were majorly 5-year tenor papers. So we are saying that there's a demand that has now shifted to the 5-year or 5-year and below space at the secondary market in terms of fixed income. Just shifting to the T-bill segment, we saw that the performance plateaued to 29.7%. In aggregate terms, that was around 7.1 billion out of the 24 billion that CBK sought in the weekly auction. Just looking at the yields from where we started the month of last month, we've seen that yields have increased by around 0.12% in those roughly 2 months period. So just to look at even the liquidity situation over the course of last week, and also as we get into a new trading week. Last week, some of the indicators that we keep an eye on, interbank, we saw it jumping by around 0.57% to 3.27%. That is the average interbank rate over the course of last week. And also, on a daily basis, CBK just assesses the situation. What's the banking liquidity? What's the liquidity in the banking sector? And if liquidity is below the threshold that CBK is looking at, they try to inject liquidity, and vice versa. If it's above, they try to mop up the excess liquidity. So the trend that we saw last week was actually CBK coming in to inject liquidity via reverse repos. Monday through Wednesday, it was a 7-day reverse repos. Thursday, Friday, it was 14-day reverse repo. So ideally, it's telling us that perhaps liquidity are somehow normalized. If we compare back to June, July period and mid-August, up until mid-August, we saw that there was elevated liquidity. But right now, we are seeing it either it's normalizing, or even there are some other factors that are at play. And one of the factors, in particularly for last week, was the settlement of the issues that were put by the CBK for the month, the primary bond issues, which was totaling 64.1 billion. So that one was mopped, quote unquote, in Monday's session. And also every 20th, each and every month, there's now the corporate tax payments, which has to be settled. So we find that it tends to, in a way, it's like a mop-up of liquidity from the corporates as they try to settle their corporate tax obligations. And we know that sluggish government spending, this in the early months of the fiscal year, and in particularly counties are yet to receive adequate funding. Although that is now behind us with now the some progress in legislation, at least to disburse funds to counties. So that could ease up in the coming few days once the necessary legislations, in particularly County Location Revenue Act, has been put in place. So that's what we are starting our week with somehow dry up in liquidity trends, which could also even have an impact in the fixed income segment. In terms of net domestic borrowing, as at the end of last week, we estimate that it was at around 258.8 billion, and that is around 52.5% of the initial target of 494.3 billion. But having said that, net domestic borrowing, there is some expectation that it will jump to around 554 billion, just looking at the budget review outlook paper. But that report should be finalized sometime end of this month to be taken to cabinet before it becomes a guide even to next year's budget policy statements. But as it is, just comparing what was the initial domestic borrowing target, that was for 94.3 billion, of which so far we've been able to, the borrowing has been at 52.5%. But if you see liquidity trends somehow remaining as it is, as opposed to elevated liquidity, we're seeing dry up in liquidity, we could see some backpedaling in even this domestic borrowing target in the next couple of months. So that will be a concern. The government intends to borrow more from the domestic markets. Finally, a week's trade. Right now, the market is awaiting the announcement of next month's primary bond issue. But having said that, if you look at the issues that have been brought by the fiscal agent, that is CBK, July, those 3 tranche issues, 5-year, 10-year, 15-year. Similarly, in September, those are triple tranche issues, 5 years, 10 years, and 15 years. And even in those triple issues, we see that even what eventually was accepted were longer tenor papers. So that is what Treasury has been focusing on, and that has been preempted even in the 2020 medium-term debt strategy paper, whereby now Treasury will be issuing longer tenor papers, at least to contain the debt sustainability. So that is something. So the market is still on the lookout. What will be next month's issue, so that they can also start trading accordingly to that. But having said that, and as I mentioned earlier on, demand is on the short end of the yield curve. And this week's trade, we're looking at FXD1 2025, or in layman's term, this is the first 5-year paper that was issued this year. It was issued in May of this year. It has a coupon of 11.76%. Last week, it had an implied yield of 10.3%. So it means that it is trading at a premium. If a coupon, which is 11.76%, is higher than the implied yield at 10.3%, that bond is trading at a premium. So we recommend that investors could even look at getting into this paper at 10.4% to 10.5% levels. Let me stop it here and hand over to Damaris in case there are any questions from the audience.
All right, thank you so much, Churchill, and thank you so much, Gerald. It was insightful as always, so thanks for that. So we've had a couple of questions coming through the Q&A and in the chat, so I'll start with the ones that came first. We have Lois, and Gerald, this is for you. We have Lois Odor who's asking, what stocks would you recommend for dividend income? Ryan also would like to know your take on EABL on a long-term buy. So is it something that you would recommend? And then Mary is asking about Scan Group. Is the share price likely to go up in the near future? And lastly, Mark is asking about Home Africa and Eveready counters. So Gerald, you have a whole spectrum of counters to talk about. Then we'll come back and handle Emmanuel's question in chat for you, Churchill. Thanks.
So thank you very much for the good questions. In terms of dividend stocks, I tend to favor the stocks that have the highest payout ratios. So from 60% upwards, but I've seen stocks that have a payout ratio of 100% like BAT, 75% and above. That is ABSA, StanChart, EABL. So those are the key stocks that I would recommend as dividend stocks. Definitely currently they are trading at very good price levels, except for this 1 year where there's going to be some issue in terms of dividend payment because of the pandemic. Then in the long term, they revert back to their dividend strategy as has been the case. In terms of EABL specifically, I think before the pandemic, the trajectory of growth in terms of revenue and PAT was quite admirable. And then the pandemic struck. We saw the results, about 39% drop in profit after tax. That was quite steep. Then we have the current situation, bars are closed indefinitely. So performance is expected to struggle a lot this year, but their market is still there. I don't think that given the 1 year duration that the pandemic is with us, they lose customers. So when they get back to the normal environment where business activity is back and consumers can can start looking at their products, then I think the trajectory will again pick up. So long term, I think it is a very good stock to get into. Current prices, of course, is multi-year lows. On average, JBL usually trades above 200 shillings. So when this pandemic is out of the way, then we expect the price to go back to those historical levels and likely much higher because the growth is still there. In terms of Scan Group, it is a stock that we usually don't keenly look at, but as you are aware, they had some transactions, some large transaction where they sold a large part of the business sometime last year. That business was contributing about 300 million shillings in profit after tax. What is remaining now is contributing about 100 million or so, as per the latest statistics. So to reflect the reality of a sold business that had a significant contribution to profit after tax, I don't think the price level would get back to where it was. I think 20 shillings and above. So we are still in that what phase I would call price discovery. Yes, we have sold this significant business. How is the pricing going to? How is the market now going to price in the remaining part of the business? So we're still under that phase, but I don't think price in the short term is expected to be where it was historically. But if they come up with a strategy that takes their profits where they were before they sell the business, then definitely the price will going to catch up in the long term. The other question was about Home Africa and Eveready. Well, two other stocks that we don't usually keenly look at. I would not be the best expert to comment on those, but if you look at Home Africa, it's more of it follows closely what happens in the real estate sector, and you know that the real estate sector has been under challenges recently. And long term, if you have a strategy along real estate, you better be having a very long term strategy around it. So the recovery is there. I think the demand for real estate is there, but the pricing there's going to be the pricing of real estate. There's going to be some challenges in the short term. So Home Africa will definitely, in the short term. Will definitely follow keenly developments in the real estate sector. Eveready, I think they have been through some turnaround strategy recently, so I'm not very keen I'm not being very keen on what strategy they are looking at, because they have already business they had, and it's called this partnership with the Energizer brand. They had some challenges back then, but it's something that I think they're still trying to find their feet in their new strategy. Thank you.
Thank you so much, Gerald. We like what you have to say about EABL, and thanks for the insights on Home Africa Ever Ready, as well as Scan Group. Let's move to the question that Emmanuel shared on the chat. Number one, he asked, does Genghis offer index funds or ETFs or a product similar to this? Churchill, maybe you could help me out with that one. Two, what level of dividend yield would categorize a share as a good dividend stock? Gerald, that is for you. And three, is it possible to include the average price buy on Jekuze app, as it is on the online trading platform? So Emmanuel, you must use both the OST and the Jekuze app. Let me start with your answer to question number 3. We'll definitely pick this up with our IT team, see if they can replicate what you're able to do on the OST on the app. I had seen Jeremiah on as a participant in our call, but I think he dropped off, so I'll definitely share that with him. Now, I see Otieno Joshua also asked a question related to Jekuze, so let me answer that before I give it over to Churchill. Good morning. A question on the Jekuze app. I would like to be able to view the performance of my stock holdings, e.g. the price at which I bought it vis-a-vis the current market price. How can I view this information in the app? Again, we will definitely follow up with our IT team about this. The good thing about Jekuze, it's a very dynamic workflow. So whenever we get suggestions or ideas, we forward it to developers so they can incorporate it into the app. So thanks for that. Definitely going to share it with our IT team. I want to add a question that I saw from Mark on the Q&A. He asks, for T-bills, do you expect the interest rate to continue on an upwards trend? And then perhaps Gerald, the last question here from John Musembi. What stocks are ideal for a short-term buy with timelines of 6 months? So Churchill, could you please take a look?
Thank you, Damaris. Thank you, Damaris. I can start with the question from Emmanuel about index funds and ETFs. ETFs ideally means exchange traded funds. So those are funds that are traded over the exchange. The one and only ETF that you have currently at the Nairobi Securities Exchange is the ABSA New Gold ETF. So that's the only one. So right now, or no other intermediary can they have their own somehow in-house ETF, but it's not traded over the exchange. So that we don't have an ETF, neither an index fund. We only have the unit trust, but that is managed by the asset management wing of the business. I hope that clarifies the question that you put up on the index funds and ETF. The question about T-bills from Mark Buni. I will just take you through the contours of the T-bills trends the last 5 or 6 auctions. We've been seeing that as opposed to the first July till around mid-August, whereby T-bills performance was over and above the 24 billion that was being sought by CBK. The last 5 or 6 auctions, we've been seeing it underperforming, and it even hit a low of 29% over the course of last week. So the fund, and ultimately we've been seeing that because of that, even the yields have started to go on an increase. My expectation is that liquidity trends, which is a major boost to T-bills, which was a major boost to T-bills yields going down, that one has somehow faded off. So in the next 1 month or 2 months, I still expect that the yields on T-bills will start gradually going up, just continue that uptrend that it has been. So that's my outlook, at least in the next 1 month or 2 months, rather than getting into a whole 6 month period. Let me leave it at that point. Gerald can pick the queries from the equity segment. Gerald?
Yes, thank you. In terms of dividend stocks, they usually have to fulfill two conditions. One is that a stock has to be consistent in terms of its payout, and its payout has to be above average. So from 60% upwards, that is usually ideal for us. And then secondly, the dividend yield has to be above average again. So we usually look at 5%, but recently we have seen yields above 10%. So the higher for us, the better. The other question was about, let's just go through it. Yes, short-term positions. So ideally, we usually don't give short-term recommendations because in the short term, the market is highly volatile, highly uncertain. But in the long term, markets usually catch up with the true value of the business, right? So I may not be able to give you some quick short-term recommendations because I'll be helping you to speculate. I am not good at speculating. But in terms of investments, to look at a longer term horizon, then there's a lot of value in the current market, especially for the big cap stocks. I think we have talked about such as some of these stocks previously. We have talked about EBL today, KCB, Equity, also trading at very good multiples. And then Safaricom, definitely at better prices than we have seen recently. I think if we can get Safaricom at 27 and below, it's a good value. Yes, so I would say in the long term there is a lot of value. In the short term, that is very speculative because again, if you look at, for example, in the short term, for example, on a weekly basis, the stocks that usually move the most in terms of percentage in price, you'll find them the small cap stocks, and they don't move on the basis of value. It's because of mostly sentiment. So it's usually very hard to gauge which stocks will perform in the short term. But in the long term, there's always a good case for most of the stocks. Thank you.
All right, gentlemen, thank you for those answers. We have Peter Kanake, who's asking in the chat, or rather in the Q&A. He's asking, have you given the equity tips for this week in terms of which to hold, long-term buys and sells? Peter, yes, we have already given the tips for the week, but you can still check out our socials. That's Twitter, Facebook, LinkedIn. You can also join our Telegram channel. But I believe, and Gerald, you can correct me, we did give a long-term buy for KCB and for Equity Group. But feel free to check out our socials and engage with us. And also, Peter, if you are a Genghis client, you do get the Genghis Cross Asset Weekly Strategy sent to you via email and in-app of Jacuzzi. So that's something you could definitely consider. We have David asking, will further COVID-related bad debt provisioning not result in poor profitability and hence further share price declines for banks in the medium term? Gerald, that's for you. And I think share trading is really a popular subject. What's your take on KenGen in the long term? That's a question from Yusuf. Gerald, over to you.
Thank you. So provisioning definitely going to pick up this year. We have seen most of the banks, reporting some enhanced provisioning levels. Some took the conservative route, some went the aggressive route. But on average, provisions are still expected to be high during the year. I think from half-year results that we saw, I think the market was, I think they expected worse than what most of the banks reported, because, for example, for Equity and KCB, just before the announcement of the half-year results, their price levels dipped to fresh multi-year lows. I think equity was about 28 and KCB at about 30. But when they announced those results, of course, with the enhanced provision levels, the banks still rallied. And currently we are talking about 36, 37. And it shows that the prices have got some resilience, and investors don't believe that, as much as provisions, are enhanced this year, that price levels at 30 and 20 something are attractive, are good price levels for the banks. So despite provisions, being elevated this year, then I still see price remain very resilient for the most part of this year. So the other question was about Kengen as long-term. Yes, I think it is a good stock for a couple of reasons. Recently, they have been investing a lot, in the geothermal strategy. Last year, they commissioned the Olkaria 5 power plant, contributed some revenue during half-year results. So this year, we are going to see the full impact on that power plant on the financial performance. And then they've been very heavy in terms of diversifying their revenue away from the electricity revenue. I've seen them going to do projects in Ethiopia and generally across the East African market. So this is definitely a good strategy for them to diversify away from that large one revenue source. The other thing about Kengen that I've always admired is despite it being a government entity, the corporate governance has pretty been strong. I think we haven't seen or had much of the issues that have pegged some of the other government entities, and this is something that we are always keenly looking at, any changes in corporate governance. But so far, I think they have been doing a very good job. And this is definitely going to be one of the key value proposition for the stock. So the other bit is about, yes, dividend. Some time back, they were very heavy on capital expenditure and growth, and they decided to eliminate the dividend. But over the past almost 2 years now, they said, okay, let's as much as we're investing in the business, let's also look at the shareholders, and they brought back the dividend. So I don't expect them to again, relook at that strategy, because if you look at where we are in terms of electricity generation and also the capacity of the country to absorb the power that we have, is still quite low. So there's likely going to be some slowdown in terms of additional capacity from power generators. So the dividend strategy is definitely expected to continue in the at least in the next couple of years. Yeah, I think that addresses your questions. Thank you.
All right, Churchill, did you address the question in terms of if the rates for T-bills interest is expected to go high? Okay, I take the silent nod as yes. Okay, and I saw your question in chat about our derivatives segment for today. Unfortunately, David Micheka was unable to join us, but we will definitely wrangle him into next week's session, and we'll be able to cover derivatives then, unless you have a question that either myself, Gerald, or Churchill would be able to address. Emmanuel, thank you so much for the positive feedback. I don't see any other questions in the chat or the QA, so I think we can draw our session to an end. But before we go, I would like to say that we get a lot of pleasure from these very interactive sessions with you, so thank you so much. Once the recording of this session is uploaded to our YouTube channel, you will receive a link of it on your email, and that will be on Wednesday morning. But before we close the session, I'd like to bring to your attention our monthly Genghis personal investment webinar. Now, this is an initiative of our asset management business. Churchill mentioned it when he was talking about the exchange traded funds. So if you're interested in learning more about that arm of our business, please join us tomorrow for our inaugural edition. It's at 10 a.m. The topic of discussion is how you can invest in the fixed income market. So please register. We'll be examining these different financial instruments. When is the right time to invest in them? How can you leverage them for great returns? You can visit any of our social media pages to get a clickable link, or you can just type in bit.ly/Genghis PIW in your browser to access the registration page. We hope we'll see you there, and have a good Monday and a great investing week ahead. All right. Thank you so much.